Hello, and welcome to Paragon Insights. I'm Jason Wild, Head of Sales at Paragon Bank. I'm really excited to kick off this episode. So this series is all about chatting with some of the key voices in the buy-to-let world, digging into the topics that matter the most to brokers, landlords, and lenders. Now today we're diving into limited company lending, which is a real hot topic. And I've got two brilliant guests joining me today, the wonderful Jenny Brown from Mortgage Finance Brokers, and the equally wonderful Michael Maynard, mobile underwriter here at Paragon. So let's get stuck in. So Jenny, MFB, an award-winning, multi-award winning, should I say, significant player within the specialist broking world. You start by giving us an introduction to the business and your role within.
Yeah, so the business has been around since the 90s when buy-to-let mortgages were essentially a sort of bespoke commercial proposition. Obviously, the world's kind of evolved massively, but in short, we've always been a buy-to-let broker. We also do homeowner mortgages, commercial investment, commercial owner-occupier bridging. So anything that's essentially a first charge, we can do. But, generally speaking, the core of our business still very much remains buy-to-let.
Yeah.
In terms of myself, so I've been with the company for 13 years. I am a broker primarily, but also as part of my role, I do a lot of business development stuff. So, YouTube videos and public speaking and producing marketing content. And I think the other thing that's always quite interesting, and I think not a rarity, but I'm relatively unusual, is as well as this kind of reach into the mortgage side of things, I'm also a landlord as well. So I kind of have a foot in both camps.
Yes. Yeah, it gives a real different perspective, doesn't it, when you've also got that landlord experience yourself. Certainly, I
Yeah.
can imagine when you're talking to some of your clients as well, you kind of get some of the headwinds that they potentially have been and will be facing over the coming months and years. And Michael, I introduce you as a mobile underwriter. So what exactly does your role entail at Paragon?
So what I tend to do is I look after a sort of a select few firms that I will go into the office on a weekly or bi-weekly basis. And I'll be either underwriting cases while I'm in the office, but also being there as almost like another BDM, so I can sort of answer all the queries. My background is that I was with another lender for about 8 years. I did the roaming underwriter role for 3.5 years whilst there, and then was in the sales team. So I've got a good bit of experience in both the sales and underwriting, which again, like Jenny said, gives you a good insight into the two different parts. Because a lot of people will see underwriting as sort of almost against the sales team, whereas we've got to be working together. We've got to be building the business in, and giving the being the decision maker is a big bonus while you're in the offices.
Yeah, I completely agree. And so what one do you favour, underwriting or sales?
Oh, good question. I mean, I
Right.
think the
You're
sales
told to
side,
sit on the fence if you want.
yeah, the sales side is obviously, I would say the more fun element. When you're the underwriter, there are difficult decisions, difficult conversations that you have to have, but it's part of the job. I'm used to it now. It's nice to be able to, well, try to give the brokers the understanding of why you're making a decision. So
Yeah,
they
absolutely.
both got its pros
I
and cons.
guess, yeah, I guess, and I'll probably throw over to you on this, Jenny, because from my view, every single case that goes to every lender is not an automatic accept and it goes through. There are cases that will be declined. And I'll always kind of take the view that the communication of that is key, that as long as you as the broker have a good understanding as to what that particular lender's issues are. And I guess with you, Michael, being field-based, it gives you an opportunity to build up those relationships with those brokers that inevitably when you get that case that you're not quite happy with, you can perhaps sit down with someone and just explain a bit more rationale behind it.
I think as a brokerage, and so, we obviously have, well, I say obviously, Michael is our roaming underwriter, and it's brilliant because, you're absolutely right. We've got a really good relationship with Michael. We trust him, that we understand his kind of psyche is that he's looking to lend, not looking to decline. And when he comes to us and says, we've got some challenges with this case, he will explain all of those challenges. If there's a way to kind of work around those challenges or, present the case in a way that's going to make it become more within credit appetite, Michael will kind of help us do that. So I think it is, absolutely invaluable. I wish more lenders actually, offer this opportunity out to brokers, because it really does help.
And to throw back to you, Jenny, a question. So, look, in terms of limited company lending, over the recent years, we've seen a significant growth in this particular market. I know you mentioned regarding MFB kind of operating in that kind of space, as have Paragon for a long time. And when you go back, kind of like 15, 20 years or so ago, it was quite rare that we were dealing with limited company inquiries, and those we were kind of your larger kind of portfolio landlords. It now almost seems to be very common now that clients who are looking at buying properties going down the limited company funding route. Well, obviously, we've had a couple of recent entrants to the market, which drives a bit more competition. But how would you describe the current lending market and what options are available out there for clients at the moment?
Yes, I think it's really interesting that you kind of reference many years gone by when I'm sure you were far too young to be working in mortgages, Jason. And the way that we've always kind of split things out at MFB is we've always kind of used our phraseology, which is vanilla lenders and specialist lenders. And a specialist lender did things like limited companies and HMOs and multi-units, all that kind of stuff. And a vanilla lender did the kind of, the fairly straightforward landlord with a few buy-to-lets in his own name, mortgaging something really straightforward. But what we've seen since we've had Section 24, as you've absolutely rightly said, is that we've seen more and more landlords move into the limited company space. Indeed, I think at MFB, 80 to 85% of all purchase transactions that we now finance are in limited companies. It was always inevitable that some of the more vanilla lenders would come into the limited company space. So I think now what we've got in my kind of simple mind, the way I like to divide things up is in the limited company space, we now have vanilla and specialist. So you've got your Coventry's, BM Solutions, who are kind of lending to limited companies, but they are absolutely not specialist lenders. They're really dipping their toe in, accepting of the limited company wrapper that sits around some people's investment structures. But they're certainly not looking to do the stuff that, some of the lenders, great lenders like yourselves, the HMOs, multi-units, all that kind of stuff as well. And what they do in the limited company space is very, very simple. It's very clean. There's certainly nothing racy. It's very, I would say, algorithm heavy. So it
Okay.
has to tick a bunch of boxes and it slides through. And then we've got the specialist lenders. So
Got you.
I think in terms of, the lending market, that's how it's kind of shaking up at the moment.
I appreciate there's probably various answers to this, but when you're looking at placing limited company business for a particular client, are there any particular key factors that you're looking for when selecting a lender? Any sort of flexibilities, or I appreciate it probably comes down to individuals, but are there any sort of key things that you're looking
Yeah.
out for?
I think the kind of process as a broker, and obviously the majority of people watching this are brokers, so I'm assuming they're going to kind of agree with me on this, is you tend to focus on criteria first. So actually, who is going to lend to this client? And then of those lenders who would lend on this situation, where does the pricing sit? Who's going to give them the best kind of pricing? I think in terms of then we get into kind of, product features. Um, we do find, I found that more landlords are sort of asking the question about overpayments than maybe they're used to, but they're not actually prepared to pay for it. So if it's a case of you can have an overpayment, but it's going to cost you 20 more basis points on the rate, they tend to say, not bothered. We're definitely seeing an increase in people who are looking for low or no ERC products. I think because a lot of landlords are kind of in the situation at the moment where they're just they're undecided about their long-term place in the buy-to-let market. So what they don't want to do is lock themselves in for long periods of time. And actually, interestingly, this isn't me just kind of bigging you guys up. It's so you've got a couple of products where you have a really low ERC in the first year, don't you?
Mm,
And then it kind of
yes.
steps up again in year two. So that's actually been really useful for clients because it gives them a kind of window of time, have a year, and then you can come out again, which is really good.
And Michael, to throw over to an underwriting perspective, we get, obviously we get a lot of inquiries, and Jenny kind of touched on this earlier, where you've got kind of landlords that historically wouldn't have gone down a limited company route, be classical, maybe husband and wife buying their first buy to let, and for whatever reason, hopefully they've got the right tax advice, they've decided to go down the limited company route. So when you're assessing from an underwriting point of view, an application that comes through for a brand new established SPV limited company, bear in mind there's no accounts to check or anything on the back of that. What exactly are you looking for from an underwriting perspective?
Well, one of the phrases Jenny used was that the limited company is effectively a wrapper around the applicants. We're still underwriting the applicants as if it was their own personal buy to let. So we'll be looking at their income specifically to make sure that we're comfortable that they can afford it, where the deposit source is coming from. When it's a day one company, there is very limited information that we can get on the business. There's no accounts, there's no filing history as such. So what we're sort of checking is to see who the directors are, who the shareholders are, make sure that everything tallies up. Most lenders will have a certain criteria that all directors will need to be on the application, and then a certain percentage of the shareholders will have to be on the application. So you'll see if it was husband and wife, for example, you'd expect them to both be directors, and then to sort of, I don't know, let's say 50-50 shareholders. That can sometimes vary. But then you might also have other clients where there's a little bit of succession planning going in, and they might have their two children, and that could be adult children or it could be young children. They would be minor shareholders so that they don't have to be on the application. So we wouldn't necessarily underwrite them. So it's just all
Yeah.
about understanding the structure really. And obviously I'm sure we'll come on to it later on, but there's lots of other ways that the structure can become a little bit more complicated in terms of sort of group structures with parent companies and subsidiaries and things like that. So it's lots to sort of get involved with a limited company. It's not always straightforward.
I think that goes back to your point there, Jenny, because from a broker's perspective, you could, I guess it's very rare that you get any two limited company inquiries that be exactly the same. That there's, as Michael touched on there, you may have a difference in number of shareholders, the shareholding percentages, and the fact that there may be multiple children on there or other individuals and stuff. And I guess from your point of view, you've kind of got all of that, and then you're going off to then try and find a home to place that. And every lender's got their own criteria there. So I guess the question on the back of that is how do you stay on top of that? Because it's kind of ever evolving, isn't it?
Yeah, it is. I mean, I think because we're doing so many limited company applications, it's relatively easy for us because this is what we do. I do feel a bit more kind of sympathy for maybe more of a kind of residential broker who occasionally gets a limited company inquiry across their desk, because I generally don't believe in this industry you can be specialist at everything, because there is so much to know. So I think, yeah, say for example, a resi broker, if they got something in with a complex shareholding structure, a layered company, that kind of thing, I do think it would be much more challenging.
And again, just from a broking perspective, I'll put you on the spot here. What's the most frequent question or concern you hear from landlords who are looking exploring limited company mortgage options?
We often get as brokers, and this is actually quite difficult, is using a limited company the right option for me?
I can imagine.
So we
Yeah.
have to, yes.
Yeah.
We can, so we do have sort of professional contacts that we can connect them to, that they can speak to. Obviously, what we're not going to do is start giving them advice on whether they should use a limited company or not, because way above our pay grade. Another one we get often asked is just about the kind of logistics about getting money into a company. So, how does it actually work? And then I think the other question we get asked a lot is it expensive to take a mortgage through a limited company? Which actually these days is not that hard to answer, because I was just kind of reflecting on this earlier. When we used to do limited company mortgages before Section 24, I mean, realistically, it was at least 1.5% more expensive compared to a personal name mortgage. Whereas these days, the sort of difference in pricing, it can be as low as 0.5% now, which for most people, it would work out beneficial. So yeah, I think they're probably the kind of key things we get asked.
Yeah. And one of the questions that we get asked as a sales team, often by brokers, is what's an acceptable form of deposit for limited companies? And,
Yeah.
and we kind of almost put it back to them and say, tell us what they want to do, whether or not it's director's loan, kind of share issue, intercompany loans. Tell us what they want to do, and we'll see if we can get comfortable on the back of it. And,
Yeah.
and just on intercompany loans, which is quite a nice segment by myself there. So for you, Michael, on this one, look, intercompany loans are becoming a more common method for funding deposits. Like I say, we get a lot of inquiries on this. And from an underwriting standpoint, kind of what documentation or assurances do you typically require? Kind of what sort of things are you looking at where you see an application come through and you know that it's an intercompany loan?
So for an intercompany loan, it effectively means that you have a company over here that might be like a trading business or another SPV that they have set up for property, and they just want to move those funds into the SPV. What we tend to ask for is accounts for the lending company. So ideally, if they're an established company, there will be a couple of years accounts that we could see what their turnover's like, what their profits like, how much sort of shareholder or retained monies they've got left in the business. And that should give us enough comfort that the company that's lending the money isn't going to be at detriment by the funds being moved to the SPV for a deposit as a purchase. The other things you might look for is making sure that the same parties that are in the lending company own the SPV. For example, if it was yourself, Jason, that owned the SPV, but it was yourself and Jenny that owned the trading business, we're going to need to make sure that Jenny is of an understanding that that money is not going to be used for something on for her benefit. So you can find that sometimes if it's a husband and wife in an SPV, but the trading business is just in the husband's name. So we'll then get what's called a board resolution letter, sort of minutes from a meeting, just to make sure that everybody's comfortable. The crux of it is that we're just wanting to make sure that that deposit has a genuine source. We can understand where it's coming from, and make sure that the fact that they're loaning the SPV, the money from the trading business, for example, that it is affordable. That's the main thing. As long as it's affordable, generally we can understand, and monies can be moved from various companies. It doesn't necessarily have to be a trading business as such.
And Jenny, just on this, and just give a feel point from the sales team. We've been involved in cases where we've been told it's, say, a director's loan up front, and then when it goes through to completion, so actually it's an intercompany loan, etc. So we've had not lots of examples of that, but I think sometimes where the borrowers have been a little bit confused how exactly it's going to be structured. What sort of questions are you asking clients then when you're coming down to this? Again, are you getting that, or what's acceptable, or this is what we've been told how we need to fund this particular deposit?
We did quite hard on this, and again, I think it just comes down to experience because we've been doing it for that long that we kind of know this is actually like a really good point. So deposit funds, which sounds like something that's really kind of fairly benign, actually can really influence who you can and can't go to. So we probably learnt the hard way, if I'm brutally honest, to be really pushing on that. So yeah, I think it's complicated because a lot of people that you're dealing with, they are landlords, they're people who have, trading businesses. What they're not is accountants, tax experts, and all the rest of it. So I do think it's worth, if you're ever not sure, at least, getting them to reference back to their accountant and saying, is this absolutely what's going on here?
Again, we normally say as a sales team, you get us a paragraph from the accountant, just email it over. If it's anything out of the ordinary,
Yeah.
we'll get it referred through as long as we can get comfortable with it. Ultimately, as a lender, you're not going to force someone to meet criteria of it being a director's loan just to meet your criteria. If they can find another way of doing it that the lender's comfortable with, well, I think, we should definitely have conversations in relation to that.
It's obviously very key that we get that right at the application stage as well, because the documents that we ask for differ from a director's loan to an intercompany loan. So I had an example recently where it was offered as a director's loan, but when the solicitor gets all the information, they then say, oh, this isn't a director's loan, it's an intercompany loan. That's then a revised offer with further documentation that we're going to have to go back and evidence. So that causes delays for everybody.
Yeah, one other point, which is not really linked to directors' loans or intercompany loans, but I always find things like direct debit mandates, certainly for a brand new SPV that's been set up. I get it from the landlord's point of view that they're focused on buying that property, getting this SPV set up and getting their mortgage application submitted and their solicitors. We find that often the direct debit setting that up with their bank or whoever they're going to bank with sometimes falls into the background and can cause issues. And it's one thing that we'll always sort of say to brokers is just flag that to the client as being important, because last thing any lender wants to do is hold up going to offer, or worst case going to completion if they sort of offer on the basis that will follow through. So that's probably a top tip that we'd always say as a sales team.
And we're quite lucky now that there's lots of banks that can actually set up accounts very quickly, whereas I think historically that used to be almost a bit of a long-winded process, didn't it?
Yeah.
Setting up a limited company bank account is honestly more painful than applying for a mortgage.
Oh,
It
really?
is.
Okay.
Yeah, yeah. I mean,
Okay.
maybe because with like Revolut and Starling and all these kinds of things have moved on. But I remember when I set up my limited company and I did a limited company bank account, and it was so protracted. Like I just couldn't believe how involved it was. So yeah, getting your bank account up and running early doors is really good advice.
But that backs up the last one that I had some involvement. They were told it's going to be 3 weeks from
Yeah.
start until it was set up. And we were kind of scratching our head on our side, saying we can't see why it takes so long. But I guess, as you say there's lots of hoops to jump through. And I know we touched on this earlier in terms of subsidiary structures. So we seem to be getting more and more inquiries of this nature. I'll throw the question open to both of you. I'll go Jenny first. So we've seen an increase in sort of subsidiary structure. It's easy for me to say, but we've seen an increase in those coming through. From a broker's perspective, what sort of things are you looking at when you get this? Because I always find, from a sales point of view, when we get these inquiries, it's almost kind of sketching out on a path that you've got this company here, and it's just kind of working your way through to basically work out who the ultimate beneficial owner is. But just interested from a broker's perspective, how you deal with it.
Yeah, so we will always, anytime anyone comes with says they're using limited company, we are straight onto company's house, looking at the company, who are the shareholders. If the shareholders aren't the people involved, it's a company, who owns that company. So we're doing essentially that. We're drawing out a kind of flow chart of the business. Um, and actually, again, I think sometimes borrowers don't necessarily understand the complexities of the companies that have been created for them. They don't really get that it's a layered company, for example. So I do think a really good piece of advice for brokers, you can go onto Companies House website. It doesn't cost you anything, but it will save you like a whole bunch of wasted time and effort, bottoming out exactly what the structure is straight away. And if it is a limited company where it's a company owned by a company, owned by people, as Michael mentioned earlier, we're looking to kind of see matching people all the way through the structure. But there are, quite a lot of lenders these days who are sort of getting comfortable with the idea of those kinds of structures. So obviously, coming back to the whole specialist, non-specialist thing, your BM Solutions, your Coventries, these guys, they're not going to do a layered company, as an example, or a more complex share structure. People who actually really understand limited companies have been doing it for a really long time. Paragon, you guys can consider these, which is brilliant.
And from you, Michael, anything from your side from an underwriter perspective?
I think, like Jenny said, it's just making sure that we can understand the ownership structure, and effectively, all it is a way to move money from, let's say, a trading business again down to an SPV in the most tax efficient way. As long as we can understand it, it's not a problem.
I do have a theory on this because what we always used to have is trading company had a bunch of cash in it. Person wants to do buy to lets, they would set up a totally separate company. So rather than sitting um, above each one and below, they were sitting next to each other. And I think there must have been some kind of change in the way that HMRC views transfer intercompany loans in that way, saying that there had to be a group structure, and therefore I think that's possibly why we're seeing more of those kinds of. I mean, I'm totally speculating here, but I get the sense that that's the case. And actually, Michael, I'm going to look really afraid now. I've got a list of questions.
Sounds like he's in trouble.
So I've got a bunch of questions that I kind of think brokers would be interested to understand. And one of them I've got written down, and just because, Jason, you just use the terminology UBO. And this is a wording that we haven't really heard much until the last kind of 12 months or so. And I reckon most of your brokers who are watching this are going to be thinking, what on earth are you talking about?
Yeah.
So I think actually, what is a UBO and what does it mean in terms of your lending policy?
So UBO stands for Ultimate Beneficial Owner. So it's all about understanding the shares within the SPV and who's allocated to them. And there's sort of different ratings of shares. So you could have 100 shares within a business. You could have one person that has 25 shares, one person that has 75 shares, but those 75 shares could be a lower grading. So although they've got more shareholding, they might not necessarily be the ultimate beneficial owner or the person of significant control, which is another term that we look for, the PSC. So it's just, again, looking at things on Companies House. We also use things like Experian and CreditSafe, which just help us to understand who actually is the main people within that business. Some lenders will look at sort of voting shares, as they're called, in a different view to non-voting shares, where at Paragon we're a bit more, doesn't really matter about the voting rights, etc. We're just looking at who the shareholders are. But there is a big difference between the number of shares to the type of shares.
Yeah, I think this is going to become more of a thing because I think when you own a property personally and you're thinking about estate planning, it's quite hard to do much with that because you can't give your child a share of a property in your own name, particularly if it's mortgaged. But now people are using limited companies. What they're sort of realizing, and I think one of you mentioned a moment ago about estate planning, is that actually we can start having our children as shareholders. What we're certainly noticing is this kind of addition of children of actually class of shares, A shares, B shares, is becoming more prevalent, as that's actually going to make things more complex for brokers and lenders. It's going to impact all of us. But I do think in terms of kind of an understanding that the market is going to go more that way because it's the flexibility that is afforded by limited company lending, which we're seeing more of. So I do think, yeah, that it's great that you guys are at least having those conversations about different class of shares and what it is you're looking for. Because I think a lot of lenders possibly haven't really given that a huge amount of thought just yet.
It sort of almost gets to the point as well where, again, obviously the tax advice that people receive is fantastic. It might well be the best tax advice you can get and how to be the most tax efficient. But sometimes that advice that is given doesn't always equate to something that a mortgage lender is going to want to see. And I think that can, from your point of view, I'm sure can be very difficult because that again comes down to the grading of the shares, and some lenders will do it, some lenders won't. But the client is then a bit like, well, my tax man told me to do it this way doesn't necessarily mean it's going to be right for us.
I feel like as brokers, we're constantly at odds with the tax advisor. So
Yeah.
what they want to do and what we're saying is mortgageable can also be very difficult. But actually, as a broker as well, because things are sometimes complicated, actually, it's good business. It's good for us, isn't it? People need us to help them with stuff like that. So it kind of has pros and cons to it, let's say.
Yeah.
Yeah, I've spoken at a few landlord events, and we'd always advise anyone who's looking at a purchase transaction to go and speak to a tax advisor on the back of it. But what we also then say is that before you act on that advice, go back and speak to your broker and say, this is what they've proposed. Am I going to make myself a mortgage prisoner or not? Because it's all right, as Michael said, I've got this great tax advice here, and speaks to Jenny, and you say, great, I've got one or two lenders for you, and the rates start at this particular figure here. And so I think there's sometimes that bit of sort of extra communication, and want to get it from the client's point of view. They're saying, but my tax advisors advised me to go down this route and do it. We're not doing anything illegal, and no one's saying they are. It's just not meeting most lenders' criteria appetites on the back of it.
Yeah, I mean, we've had so much of that with this the beneficial interest company trusts, which I know you guys have, you understand this stuff, but this is one of those really prime examples where we just kind of, are butting heads with tax advisors all the time.
Yeah, I'd say in relation to that, without going into any sort of real sort of specifics, I'd always say the brokers we speak to, I'd say if you've got clients and the name on land registry doesn't match the party declaring the rent and doesn't match the party on the mortgage application, you need to pick the phone up and speak to that lender in advance, because sometimes we're finding applications that come through that's in personal name, but rents are going through limited companies, this, that, and all sorts. I'm not saying they're doing anything wrong. You need to obviously check every lender's got their own criteria, stance, what they are and what they're not comfortable with. And it's always worth a conversation up front on that.
Definitely. Good advice,
Definitely.
Jason.
Oh, thanks very much. I'm full of good advice. Well, one bit of good advice. Jenny, just throw out to you. If you could change one aspect of limited company lending, so whether or not it's criteria, process, or product design, what would it be and why?
I'd like a 5-year fixed rate at 2.5%, please.
Okay.
Joking.
I'll see what I can do.
Do you know what? I think one of the things that I feel would be really useful, actually, this isn't just limited companies, it's to landlords. And I'm sure there's a really good reason why lenders don't offer this, is offset mortgages. Because throughout the year, every property investor, whether it's in a company, is saving to pay
Yes.
a whopping great tax bill at the end of the year. And so it would be a really great feature for them to have. And I don't know. I think at one point, I think it was the Family Building Society used to do an offset mortgage for personal name borrowing, but there just isn't that in the market. And I do feel that for landlords that could be a really great proposition to have, but nobody's offering it at the moment.
I do agree with you. I think it'd be a fantastic addition, and certainly something unique from that side of things as well. Any final point from you, Michael? I'll give you one wish if you could change anything. Anything from your side of things?
I suppose if you were looking at it with an underwriting head, it would be places like Companies House, Credit Safe, to maybe, if we could somehow get more information, to be clearer on how the structure is held. Because that sometimes does take a little bit of investigation. Because if we're looking at an SPV and then that SPV has two directors, shareholders, another company, we're then looking at that next company, finding out who that's owned by. And then by the time you end up, you could have 6, 7 tabs open trying to understand structures. So, that would obviously be very, very helpful. Credit Safe is actually probably one of the best ones for that, because you do get that little flow chart that gives you a breakdown. I think that would be ideal, because then just creates everything a little bit easier.
So it's also then fair to say that if Jenny submits one of our clients that's got a really kind of complex structure, you've been through, you've understood that, we've gone through, issued the mortgage offer, it's gone through the completion. The next case that then follows through a couple of months down the line for another purchase, am I right to say you've already got that understanding of that structure, who the landlords are, who those ultimate beneficial owners are? Does it become a little bit easier from your point of view? And then as a knock-on, should it become easier from Jenny and the landlord's point of view?
Absolutely. From an underwriting perspective, we would generally always refer back to a case that is recently completed, so we can make sure that, firstly, everything is mirroring what we lent on previously, but then we've already got documents, notes to be able to refer back to. If it's really recent, we can copy the majority of documents over, so the only things that would be needed to re-upload would be anything that would be out of date, say up-to-date bank statements, up-to-date pay slips, something like that. So yes, definitely a lot easier when it's repeat business for same clients, same structures.
Thanks, everyone, for tuning in. We hope you found the chat around intercompany lending useful and maybe even picked up a few insights. Massive thank you to Jenny and Michael for joining me today. And we'll be back soon with more conversations across the buy-to-let market. So make sure you stay connected. Thanks very much. We'll see you next time.